Hey guys, Jared here. I hope you're doing well. In this video, I want to run you through a little thing called a death tax. Now, this relates to the tax that you might have to pay, not you in particular, but your beneficiaries from your super. So what is it? Basically, it's the tax that your beneficiaries will have to pay on the taxable component within your super fund. So your super fund will have two components, taxable and tax-free. The taxable component is all the money that's gone into your super from your employer contributions and salary sacrifice, basically, plus the growth on that. So more often than not, your super fund is going to be made up 95% of taxable components, unless you've dumped in a whole heap of money as a personal contribution from an inheritance or a downsizer, for example. Now, when is this potentially paid? So if you have a partner and they're down as the death beneficiary and your super goes to them upon your death, there's no tax paid because they're a financial dependent upon you. But anyone who's not a financial dependent upon you, that's where the tax is payable. And the most common answer to this is when it is paid to your adult children, who they're financially independent, not dependent upon you anymore. So they have to pay 17% tax on the taxable component. So for every 100 grand in there, $17,000. So it can add up to quite a large amount of money. So how to reduce it? So the strategy that we use to eliminate this or cut down as much as we can is called a recontribution strategy. That is, in very simple terms, you're withdrawing the money out of super and putting it back in again. Now, you need to, how to withdraw money from super, you need to be over 65 or over 60 and retired, whichever comes first. And then to get money back into super, you need to meet the after-tax contribution thresholds of how much you can put into super. And there's rules on how much you can put in as an after-tax contribution. It's $120,000 per year or $360,000, bringing 3 years forward and doing it at once. Now, I've got a bit of a case study at the end of this video, so I'll go into that in a little bit more detail. But once you've got that money in there as an after-tax contribution, that goes in the tax-free component category, meaning that when it passes on to your adult children, they don't pay tax on that aspect. So what to watch out for? As I said, you don't want to go over the super contribution limits. Otherwise, there might be some fees, interest payable from the ATO. The other thing to watch out for is when you're withdrawing money out of super and putting it into your bank account, you're going to have time out of the share market potentially. So you want to make sure that you're timing that correctly, that you're not missing out or limiting the amount of time you're out of the market. You're not missing out on any growth. You want to make sure that you're putting in the BPay details or account numbers correctly on your super fund to make sure that you're not transferring it to the wrong place. You want to make sure that there's no way, no sniff of any scammers being involved. If people are emailing you the details, you want to make sure that hasn't been hacked and changed and you're paying them. That's how scams can happen. So the ways around that, there are certain types of super funds that we use that remove all of that risk that I just mentioned, where you have no time out of the market. You have, there's no involvement of you transferring money. The super funds that we use, they set up a temporary bank account right next to the fund within the same company, and it goes in and out in 1 second, and it's as if it never happened, and you don't have to have any time out of the share markets or incur any buy-sell fees in selling shares or investment funds. So here's a case study to give you an idea. Bob and Betty, names changed for obvious reasons. Bob, he's the only one with super. Betty has never worked. $940,000 in his super fund he had built it up to, quite a significant amount. And 95% of this was in the taxable component. So basically all of it was taxable. So as it stands, if he and Betty were to pass away now and it was paid to their adult son, 25-year-old Brad, he would have to pay $200,000 in tax, only therefore receiving $740,000. So what we did, we set up a fund for Betty. So then they both got a super fund. And then we went and did our recontribution strategy. 1st of May, we did $120,000 out of super, then back in. And we set up a new super fund so it wouldn't get messed up with the other money that was in there. And then with the remaining money, as soon as we hit a new financial year, 1st of July, we triggered the bring forward rule where you can do 3s at once. And we did the remaining amounts, $330,000 each, out of super, then back in, effectively cleaning the whole amount of the $900,000, making it 100% tax free, potentially saving $200,000 in tax. So a very valuable strategy. Just giving them peace of mind that they do plan on spending all that $900,000, but the thing is, death doesn't give us 2 weeks' notice. So the outcome, as I said, 1 super fund each, $450,000 balanced in each super, 100% tax-free component, 0% tax paid by adult son Brad if they were to pass. So hopefully that gives you a bit of a better idea on how it operates, and a few things to watch out for. But it is quite a complex strategy, so definitely I would be seeking financial advice in relation to this to make sure that you're within all the realms of staying within the thresholds and avoiding any mistakes and avoiding time out of the market. Thanks, guys.